Good afternoon, everyone. I'm Greg Olma with Key Performance Ideas, and I'd like to welcome you to our webinar, Driver-Based Rolling Forecasts Simplified. Today's webinar will be presented by Deanna Sunde. Deanna is an Oracle ACE Associate and Delivery Director for the West Region, a recognized thought leader in the EPM community. Deanna is a frequent speaker at user group conferences, including Oracle Open World, Collaborate, and Kscope. She is also a certified implementation specialist for Hyperion Planning and S-Base. Welcome, Deanna, and thank you for joining us today.
Thank you, Greg. Our agenda today is to first discuss some of the general benefits and key trends within the planning space, and then we'll talk about driver-based planning, including benefits and methodologies, some driver examples and trending examples, and then we'll talk about rolling forecasts, including best practices, some examples for rolling forecasting, and some built-in support that Oracle has built into the cloud product and the on-premise product, and then some calculation examples. So the benefits of proper planning, there are some financial benefits, technology benefits, and business benefits. So the financial benefits are the ability to accurately plan revenues and costs and to control them. It provides a lean and dynamic organization and higher profitability. You can gain a competitive advantage, and you can also more quickly adapt to changes in market conditions. Technology benefits are that there's a proven performance and scalability to your system, ease of maintenance, and the ability to fit seamlessly into an existing security model, and that certified adapters are available with the largest ERP vendors. Business benefits are the ability to link strategy to execution and to develop dynamic driver-based planning and forecasting, and also event-based planning and forecasting rather than just being based on a particular cycle, either monthly or quarterly. It allows for increased accuracy and the ability to drill through to other valuable data sources like your ERP for more in-depth analysis. Key trends in planning are that driver-based budgeting and forecasting is being used more for key business drivers, and rolling forecasts are key for doing rolling forecasting for key P&L and balance sheet items for your company. And modeling for balance sheet and cash flow, we're finding more companies that are not just doing planning and forecasting for the P&L, but also for balance sheet and cash flow. And another trend is the more frequent updates to the forecast, instead of just like quarterly, being done more monthly and on event-based, and also rolling forecasting, of course. So the benefits behind these trends are improved visibility into what drives the results, and also improved accuracy when you're doing your forecasting, the ability to capture market changes into your forecast more quickly, and better visibility into your cash flow position and funding needs, and planning cycles that are shorter and require less effort. Strategically, the focus is on implementing strategy rather than short-term budget goals, and event-based planning rather than quarterly or monthly cycles. So some of the benefits of driver-based planning. Using drivers to generate budget and forecast reduces the effort needed to execute the planning process. It shortens the cycle time needed to complete your budget and forecast, improves accuracy. So driver-based forecasting may increase your accuracy if you understand the relationships and dependencies between the different business areas and accounts. Driver-based forecasting does require a deeper understanding of your operational supply and demand, whether that is your inventory or your human inventory. It improves accuracy and variance tracking and analysis, which can lead to more forecast accuracy improvement. So keeping track of the accuracy and understanding the variances between your budget and forecast and your actuals will help you to further understand your business and improve your accuracy prediction, so you can maybe find some more drivers or change the driver values as you go along in order to improve your accuracy. Updating drivers will flow through to the related items instead of teams working in silos. Historically, if you're putting together like a forecast or a budget in, say, in spreadsheets, for example, you might get, the sales from one team and the cost of sales from another team, but those like units between those two inputs don't necessarily agree, so you know that your forecast is really not accurate because you're not basing it on the same assumptions. Another example is updating your commodity costs for things like your standard costs and your inventory. So if you update your commodity costs, they can flow through to your standard costs and your inventory. When you do driver-based planning, it supports creating different versions of the budget and forecast more quickly and easily. So if you adjust those levers for the key drivers in the company, it allows you to create like low, medium, or high versions, or doing things like what-if analysis. And that also applies to sensitivity analysis, so that you can change your price assumptions for key commodities, for example, and determine the impact on the P&L at different price levels. I had an oil and gas company as a client once, and that was a big thing for them to be able to change the oil and gas price, and for them that reflected in their revenues, and they had some price sharing schemes so that those plans and volumes were also impacted. So doing that sensitivity analysis was really important for them. When you look at what kind of a methodology to use, you need to look at both the variability of the particular item as well as its materiality. So if something is low materiality and it doesn't vary very much, it's good to either forecast at higher levels across dimensions such as maybe your counts and departments, just bump it up a notch, or just not forecast it at all if it's really not material. Something that is low in materiality but varies a lot, best practices would be to evaluate that item and determine what is the best methodology for that. If something is high in materiality but not variable, a good method to use is like a run rate or a trending method in order to trend out that over time and to capture seasonality, and then to kind of look at the result of that, and if you have any exceptions, you can tweak your forecast for that. Something that is very high in both materiality and variability is a really good candidate for using drivers. If you do have to do something very granular and detailed and do it bottoms up, the best situation in that case is to kind of do that the first time and then just have that flow through and then look for exceptions after that. So again, you're not spending your time on things that are not material and don't vary off very much. Here's some examples of drivers. Kind of the most well-known ones that Oracle also has modules for are workforce planning and capital asset planning. And in general, the biggest type of use of drivers outside of those items are your revenue, your cost of sales, and things like discounts and allowances. So things that contribute to your net sales, but expenses can also be driver-based. Accounts that are driver-based and the drivers that are used will vary by industry and by company. For workforce planning, this allows you to calculate salaries, bonuses, overtime, 401k benefits, payroll taxes, and benefits based on drivers. The drivers that would be used would be things like a merit percent increase that could be done globally or by different job grades or positions. Also inputting as a driver things like payroll tax rate, bonus rates, overtime rates, benefit rates, 401k contribution rates. Also for new hires, you can have a standard driver that each new hire gets a laptop, etc., and have that built into your capital plan. New hires for a salary driver, that could be based on job grade or or position so that a user would select that, and then that would just automatically give the correct salary or a midpoint salary. That could also be varied geographically, or they can just input what the salary is in dollars or local currency. Workforce planning is often a separate plan type, and it is out of the box if you buy the module. Due to differences in dimensionality, because it includes the employee dimension and the job dimension. For sales bonuses, what you can do here is assign a UDA, which is a user-defined attribute, which is basically a flag on the employees, or an attribute, which is a similar thing technologically. This would designate which employees are to receive that bonus, and then the calculation can use different bonus percentages and apply that. For capital asset planning, this gives you the ability to plan capital spend, depreciation expense, the cash flow, and the balance sheet for PP&E accounts based on different drivers. So in this case, your drivers are lives by asset class, the different depreciation methods by asset class, salvage value percentages. You can build in like percentages of cash paid by time period. So if the item is delivered, say in January, you have a 30 net payment with the vendor, you can have it paid out the next month so that your cash flow is accurate. You can also build this into a separate plan type because it does use different dimensions than your typical planning application. There's a dimension for line item and for asset class. So the line item is the actual asset itself. Asset class would be the type of asset it is. Here's an example of a project that I did for a biopharm company and how their different accounts laid out across the different types of drivers, methodologies that could be used. So things that were driver-based were like workforce, their product sales, the cost of goods sold, government discounts, and clinical trial. The run rates were used for a lot of the SG&A expenses. We built a special form where they could select different trending methods, which I will demonstrate later. The forecast for some of the other items were done at a higher level, and some were done bottoms up, things like the rent and insurance and taxes. Some of the other activities, which were high variability but low materiality, were done with sometimes bottoms up and sometimes at a higher level, things like the launch activities, consultant expense. This shows how the drivers for the revenue and cost of sales were done for this company. So they had drivers such as the dosage, split percentages, different unit prices, and who was being paid. So they had a different mix between different companies and government agencies, and that would drive the sales and the discounts and allowances and the cost of goods sold. In the banking industry, it's important to calculate the balance sheet and the cash flow, much more so than other companies, and looking at both the existing portfolio and new loans. The drivers here are looking at the portfolio runoff of loans, calculating new loans and rates by looking at the average balances, the weighted average rates, projected treasury rates and spreads, and the analytics that are for banking that are looked at are things like rate and volume analysis. For retail, the things that are being calculated by drivers are sales and cost of sales. So the drivers for sales are looking at like stores based on different bands, based on square footage, bands based on the box type, whether they're a regular store, a superstore, or an express store, for example. Applying organic growth rates to those bands. Also considering relocations and remodels that may increase the sales for those types of stores, and just the overall environment, like looking at the competitive environment, whether opening a new store cannibalizes other stores that are already there, whether store closures may lead to increased sales in other stores near that location. For cost, so the drivers there are looking at the percentage of merchandise sales, and that can also be based on last year or put in as an input or driver for based on other factors. Also looking at cost in terms of square footage, that also has an impact. For the analytics for retail environment, things that are very important to look at are the comparable store sales and also cohorts. I'm at a company now where it's a retail company and they have different programs that be rolled out at different locations. So that is one of the things that they analyze. For a global manufacturing company, again, we're calculating the sales and cost of sales. Drivers are standard costs, inventory levels, how many shifts there are at different plants, how many lines there are at different plants, whether a new plant is being opened or they're being closed, what new products are being delivered, and a big thing too is looking at currency rates. So the analytics that we can gain from this are like constant rate currency scenarios, so looking at what the currency rate differences are and how much the variance is coming from currency, and also looking at the rollout of new SKUs for the first 12 months. So some run rate and trending examples. So this is an SG&A form that I developed for one client. They were pretty much forecasting by quarter, but they did have the ability to, drill into these quarters and input into individual months. So the way they looked at things was first looking at the first 4 quarters would be actuals, just so they could see, what was happening. And then the next 4 quarters they did input, and then they used some growth logic and some trending methods in order to calculate out the next 2 quarters. So the future quarters were less known, so trending methods were used versus the first 4 quarters. They had a better idea of what it would be, and they input into those. So for the growth logic, there are different trends that can be selected, and also different growth percentages that could be used. If no trend is selected, they could actually input as well. So the different levers that we call these, the 2 different levers, the look-back horizon, which is a trending method. So we built in the ability to base it on prior quarter, prior half year, prior year, or seasonality, which would be applied by month, different seasonality. So you can build into your system whatever ones make sense for you. And then you can also input a growth rate on top of that, either positive or negative. So here's some best practices for rolling forecasts. Historically, forecasts were done just to forecast out to the end of the fiscal year, but best practices are to go beyond the current fiscal year, the same number of out periods each time. So if you're doing, say, 18 months, this forecast, you would do 18 months the next time that you forecast. The number of periods that you go out will differ by industry and company. I would advise you that it makes sense to go out the number of periods for which, you have information. The further you go out, if your drivers you don't think are very reliable, well, then your forecast is not going to be either. So that's something to take into consideration. So historically, forecasts have been done with a consistent cycle, for example, quarterly, but best practice is really for that to be more event-based. So not necessarily every quarter or every month, but when something big kind of happens in your industry that changes your drivers and your environment where you want to do a new forecast. Historically, planning has included the entire organization, but best practice is really to have fewer people involved in the process. It does tend to be more accurate. If you have like 100 people involved in the forecasting process, quite often people will just not actually do the forecast, and then you don't know whether it's completed or not, or if it's accurate or not. So if you do, fewer people are involved, you can keep track of things easier, and those people are actually more invested in the outcome of that result. Historically, forecasting has been to do many line items, but best practice is actually to do fewer line items, because again, it's not just easier, but it also is more accurate. So level it up in terms of like accounts, business units, products, and customers, for example. Historically, forecasting has been more for financial line items only, but best practices is also to do forecast your various assumptions as well as non-financial input, like different statistical information as well. Historically, forecasting has been to come up with like one number, like your net profit is $1 million. But best practice is really to do different versions based on different assumptions and actually come up with a range of value rather than just one figure. So we believe, our forecast is going to be between $800,000 and $1.2 million, for example, for the net income. While rolling forecasting has been around for a while, more leading companies are actually implementing rolling forecasting to meet their company's needs based on their industry. So some other best practices are, keep the forecast fresh and relevant. New events and better understanding can drive a consistently improving process so that your forecast is more accurate and leads to better decisions and fewer surprises. Doing rolling forecasting will actually reduce the effort you need to complete your annual budget because since you're forecasting more frequently, you only have to forecast out fewer periods. So doing an annual budget is not so tedious or burdensome. The timing and granularity should balance the effort that you're putting into doing the forecast with the value that you're getting out of it. So again, instead of thinking of like doing a monthly forecast, rolling forecast, do your updates, say, quarterly or based on events. So this I call kind of the Angry Bird approach. Each time you do your forecast, you get a little bit closer, you get a little bit better, you know what you're doing more, you know what your drivers are and what those values should be. So each time you just get, a little bit more familiar with the whole process and the calculations, and you do a better job of forecasting each time. There is built-in support for rolling forecasts. On the cloud, there are forms that you can use and using the form designer, and you can set up the rolling forecast years and the periods that you're doing it for. This requires that the period and the year dimension is in the column. The substitution variables are created on the fly from the form, and the values are assigned to them automatically. And when you shift your forecast for the next time that you do it, that is auto-generated for all the forms that have been set up for that rolling forecast. So in order to do that, you open up a form, and you create a new form by going to the Create and Manage Forms. On the Layout tab, you would right-click on the column, and you select Rolling Forecast Setup. And this can be done on any form, as long as, again, the period and years are in the columns. Once you do that, you would select a prefix. In this example, it's RF for rolling forecast. Use a start year and a start period, and then the periods that you want to go out. Because there's a prefix involved here, you can actually set up different rolling forecast periods. So if you do your revenue differently than your expense, for example, you can have different periods. Once you do that, your form is updated. As you can see here, the substitution variables RF year 1, RF period 1 are set up on the form. And the substitution variables are set up in the system as well. So those variables can be used both in forms and in reports and in business rules and calculation scripts. So for on-premise, the built-in support for rolling forecast was first introduced in version 11.122. The process to do it is similar to the cloud that we just saw. For versions prior to that, you can create your substitution variables manually. And again, those variables can be used in forms, reports, and business rules and calculation scripts. For rolling forecasting calculations, because you're spanning period and year, you would need to cross years in your calculation. One option is to create basically a duplicate script or different sections in the script that is duplicated within different fixed statements. That can result in lower, slower rules, and the users may not be happy with that. Another option is to use the X-range function, which will cross the fiscal years within one fixed statement, so it's more efficient. So in this example, we're doing a 15-month rolling forecast, starting with April of 2016 and going through June 2017. So that will return all the members in between that. So here's an example of it within a particular script, like we would first fix in on the forecasts, which are substitution variables for the years, and then we use an isMember function with that X-ray that we just saw, and then you would just put your calculation logic within there. For an aggregation, you can have like two different options here. This first option would be the most efficient, where you specify both of your years and January through December, so all of your periods, and then you run your aggregation. Or if, for some reason, you do not want to aggregate actual periods that are closed that are prior to your rolling forecast, you can create two different fixes. So the first one for like your first year and your second one for the second year. That actually should say forecast year 2. So for your forecasting horizon, in this example, there's 18 months. So we have the first 4 quarters and then another 2 quarters. So what we want to do here is to de-emphasize doing like your actual versus your forecast variance if they don't impact future periods. Instead, we want to focus on kind of the go forward, what our outlook is looking like. So one way to do that is to look at the overlap between the different forecast periods between this forecast and last forecast, or some other prior forecast. Like in this example, there's a forecast and there's 3 forecasts prior to that. What makes sense to analyze are these 2 overlapping quarters. This also allows you to look at seasonality. And this example here is a 15-month overlap when we're looking at this forecast versus the forecast immediately prior to it. So those, in this case, those 4 quarters make sense to look at. So in this case, I've developed a kind of custom approach here to calculate dynamically these overlapping periods. So we have these base periods and then the comparable periods, and then both variances and percentage variances. This is within the period dimension, and then to get the rolling 6-quarter total, we have created shared members here for the first 5 periods and then the last quarter here. So within each of these, base members, we have calculations, which I'll show you next. The formula for doing the variance between these periods are just taking an @bar function that takes the P1, base P1 period versus the comparable CP1 period. And so here's an example of, what a script would look like that would be dynamic. So we're looking at, using formula functions such as the shift function. So if it's the report or SmartView query is looking at forecast, it just picks up the regular period, year, and version. Otherwise, if we're looking at the forecast 1, which would be the last forecast, we're shifting our periods here in order to come up with what the periods are for the base period, going back to the appropriate quarters. We would do something similar for the comparison periods. So I want to thank you for attending my webinar today. Take it away, Greg.
Thank you, Deanna, and thank you all for joining us today for the webinar Driver-Based Rolling Forecast Simplified. If you have any questions, please don't hesitate to contact us. Deanna's and my contact information are displayed on your screen. Thank you again for joining us today, and have a great day.